Hey everybody, Mike Nelson from EfficientLending.net. First and foremost, as always, thanks for checking out my content online, my blog, my YouTube channel, wherever you're picking me up. I always appreciate it when people spend time with me online. All right, I'm excited about this, but I get excited about mortgages. We're going to do our first installment of our five-minute-ish video series on how to choose the right mortgage for you. And the logical place to kick off the series is just making a quick definition of a conventional loan versus a government loan, because that's where the vast majority of people are going to kick off their search for mortgage. So let's start right there. All right, on a conventional loan, you'll also hear as a conventional conforming loan. It's pretty simple. Conventional just means it is not insured by the federal government, and conforming just means it conforms to Fannie Mae or Freddie Mac guidelines. I won't dive into those, it's just way too much detail, but in essence, if you conform to Fannie Mae and Freddie Mac guidelines, you're a more highly qualified borrower, you have typically higher FICO scores, and consequently, you're going to be rewarded with a less costly loan. So that's a big deal about what a conventional loan is. The other point I just want to bring to the forefront here is mortgage insurance. On a conventional loan, you're going to pay what's called PMI, private mortgage insurance, and you can get conventional loans up to 97% loan to value. That means a minimum of 3% down payment. The big thing to remember for the conventional loan is that by law, it has to come off, that mortgage insurance, at a loan to value less than 80%. And also, the borrower who uses a conventional loan, the higher their FICO, the greater the down payment, naturally above 80%, they're going to pay a lower PMI monthly payment. Big deal. Let's talk about government loans real quick. Government loans, as opposed to a conventional loan, are insured by the federal government. You'll typically see three types of FHA or government loans: FHA, USDA, and VA. VA is my favorite loan, by the way. It's reserved for our veterans. It's a great loan. I'm going to focus on a FHA loan right now for you. FHA loans are typically for the more lower qualified borrowers. They have a 1.75% upfront funding fee for mortgage insurance, which is significant. And your monthly mortgage insurance, if your loan to value is higher than 80%, is the same across all loan to values and all FICO scores. So it can be much more expensive. And lastly, on the FHA loan, it stays on your mortgage as long as your mortgage is alive. So unless you refinance or sell your home, you're going to pay mortgage insurance to perpetuity of the term of the loan. Big differences. All right, I know that's a little dry, a little technical, but those are the two big differences between conventional and government loans. I hope that helps kind of differentiate or get some ideas on how to choose the right mortgage for you. And next week, we're going to come with really what is my favorite topic, which is going to be rate and term. I hope you can join me. Thanks again.